Hello, everyone, and welcome to today's webinar, Understanding Nonprofit Financial Statements. I want to thank you for taking time out of your day to join us to go over financial statements. Hopefully, we can provide you with some additional information today when you're looking at your nonprofit organization's financial statements. Before I get started, I just want to introduce myself for those of you who I haven't met before. My name is Carrie Minnick, and I'm a partner here at DWD in charge of our nonprofit team. This webinar will be recorded and will be available to review after the webinar has ended on our website. We will also be emailing out a copy of all the slides to the attendees as well. If you have any questions during the webinar, feel free to add them to the question and answer or the chat window, and we will try to answer those. We do have a lot to go through today, so if we don't answer your question during the webinar, we will send you a follow-up email with the answer to that. So let's get started. Before we jump into the financial statements themselves, I just want to touch on a few items, just kind of some background on nonprofit financial statements. First of all, who's really looking at your organization's financial statements and why? So unlike for-profit financial statements that are mostly kept private within the organization, nonprofit financial statements are available to a lot of different people. Obviously, the board of directors, they're going to want to look at your financial statements. Their responsibility is to oversee the financial health of the organization, ensure compliance, make strategic decisions. Management and staff to plan budgets, track financial performance, and manage resources effectively. Grant makers and foundations to evaluate financial responsibility, determine eligibility of funding. Donors and funders to assess financial stability, stewardship of funds, impact before making a contribution to your organization. Regulators and government agencies to ensure compliance with tax laws, nonprofit status, and reporting requirements through Form 990, which we'll talk about a little bit later. Auditors and accountants to verify financial accuracy and compliance with accounting standards. Banks and lenders to assess creditworthiness before offering loans or lines of credits. And then just beneficiaries, people that are engaging in your program or services, and the general public to ensure transparency and accountability in how funds are used. So it's really important that your financial statements are accurate and reflect the true story of your organization. The next thing I want to touch on is the different basis of accounting. So when we're looking at a financial statement of an organization, we need to understand what basis of accounting they use because it's what we see is going to vary based on what basis of accounting they use. So the first is the cash basis. This is the easiest basis of accounting. Revenue is recorded when received and expenses are recorded when paid. So this is exactly like how you would record your own finances at home. When you receive your paycheck, it gets recorded as revenue. When you make that utility bill, a payment, it gets recorded as an expense. It's very simple and easy to use. A lot of smaller organizations with limited financial activity or those that don't have a lot of reporting requirements will follow the cash basis. However, it does lack some insight to outstanding obligations such as payables, those invoices that haven't been paid yet, or receivables, those items that people haven't paid you for yet. So the next basis is the accrual basis. So this is kind of the opposite of the cash basis. Under the accrual basis, revenue is recorded when earned and expenses are recorded when incurred. So that's a little bit different. So this means that in the nonprofit world, when a foundation says that they are going to give you a grant, congratulations, we are going to award you a 3-year grant totaling $300,000, but we're going to pay you $100,000 per year over the next 3 years. That full grant of $300,000 under the accrual basis needs to be recorded when you are notified that you are going to get it. Under the cash basis, it would be recorded when the payments are received. Same thing with expenses. They are recorded when incurred. So that means when you've made a purchase of an item, when someone has provided a service to you, that's when it's incurred. And even though you haven't made the payment for that expense yet, it gets recorded as an expense in an accounts payable. This really provides a more accurate financial picture for what is going on within the organization. It provides a true picture of all of your revenue and expenses and aligns with GAAP, generally accepted accounting principles, if your organization is required to prepare financial statements on GAAP, which a lot of larger organizations, those organizations that receive funding from a government entity or maybe from a larger grant, may have to put their financial statements on the accrual basis. So that's kind of the difference between the cash basis and the accrual basis, really two separate ends of the spectrum. However, we have this middle ground, which is called modified cash basis. And under the modified cash basis, it's kind of a hybrid approach. We start with the cash basis. So we're recording revenue when we receive it and expenses when paid. But we're going to add some pieces of the accrual basis accounting. For example, fixed assets is a very common modification to the cash basis, where we're going to record our fixed assets and related depreciation, because those are assets of the organization. And we want to include those on our balance sheet, because that way the person reading the financial statements sees that we own those assets. It's often used by nonprofits that want a little bit better tracking, but don't require the full accrual accounting. Now, the one thing with the modified cash basis, you can't just pick and choose what you want to include and what you don't want to include under the accrual basis. So again, some very common modifications are fixed assets, investments at fair value, maybe loans and payroll liabilities. So you couldn't record accounts receivable under the modified cash basis. You wouldn't record accounts payable under the modified cash basis, because when you're doing that, that's just a lack of following the accrual basis, and we don't want that. So there's primarily three different bases of accounting: cash basis, modified cash basis, and accrual basis. And so you really need to understand, when you're looking at the financial statements of an organization, what basis of accounting they follow. Now, I will say that there are some organizations that follow a fourth basis, which is kind of a mixture of all of these. So for example, they might say they're on the accrual basis for internal purposes, but really they don't record contributions receivable, or they don't record prepaid. So if you're looking at your internal financial statements, it could be that they are said that they're on their accrual basis, but maybe not all the accruals are recorded. And so at the end of the year, when your auditor comes in and does an audit, they record some of those adjustments. It's okay for internal purposes to not record those certain types of accruals, but again, you need to understand what's being recorded and what is not being recorded when you're looking at your financial statements. So I wanted to show an example here. So this is a statement of financial position, which is basically the balance sheet. So we have our assets, liabilities, and net assets. And if we look at the first column, this is the cash basis. So if this organization was just on the cash basis, all we would record was cash. So we would record $473,000 of cash, and then we would have net assets would be the opposite side of that. However, if they're on the accrual basis, that same organization is going to record $8.6 million of assets compared to $473,000. Because under the accrual basis, they're not only going to record cash, but they're going to record the receivables that people owe them. They're going to record prepaid. They're going to record investments and fixed assets. They're also going to record those liabilities, the accrued wages and withholdings and accounts payable that they owe to other people. And then the final column here, you can see the modified cash basis. So again, that same organization under the modified cash basis, they would record cash, but they wouldn't record contributions receivable or prepaid, but they would record their investments in fixed assets and wouldn't have any liabilities. So I wanted to give you a picture of a comparative, same organization under the three different bases of accounting. So it really gives you a picture of, hey, let's, depending on what basis of accounting the organization follows, you're going to see some different things. Now, we need to, once an organization picks a basis of accounting, that's what they stick with. They don't usually flip-flop back and forth. So if your organization is on the accrual basis, you stay with the accrual basis. Modified cash basis, stay with modified cash basis. So, but I just wanted to give you a picture here of what the different financial statements would look like. Now, obviously, we don't have revenues and expenses included on this statement, but that would also differ. So when you're determining which basis you're looking at, this kind of gives you an idea of what you might see and might not see. All right. Also wanted to cover nonprofit versus for-profit. Some of you maybe come from the for-profit world and maybe serve on a nonprofit board or have experience in the for-profit world. So you'll see there are some differences between nonprofit and for-profit financial statements. For just kind of overall, the purpose and focus, nonprofit financial statements focus on accountability and stewardships of funds. We're making sure, this money is coming in, where is it coming from, and what are we using it for? Versus for-profit, who really focuses on the bottom line and profitability. Under the nonprofit financial statements, the goal is to demonstrate how our resources are used to fulfill the organization's mission. So that's a little bit different focus. We also have different financial statements. So when we look at the required financial statements of a nonprofit, we have 4 of them: a statement of financial position, statement of activities, and statement of functional expenses, and statement of cash flows. And you can see the comparative in the for-profit world. Statement of financial position called balance sheet. Statement of activities called an income statement. Now, the statement of functional expenses is not required in the for-profit world. However, some for-profits do record expenses by department or job internally. So that's kind of a similar statement. But again, a full-on statement of functional expenses is not required in the for-profit world. And finally, we have the statement of cash flows, which is required in both nonprofit and for-profit. We also have some different terminology when it comes to net assets versus owner's equity. So in the nonprofit world, our owner's equity is called net assets. And we have net assets, they're broken into 2 categories: without donor restrictions and with donor restrictions. So in the nonprofit world, a donor can make a contribution to a nonprofit, and when they make that donation, they can restrict it for a specific purpose or a specific period of time. At the end of the year, if those contributions have not been spent, then they are recorded as net assets without donor restrictions or with donor restrictions. We don't have that in the for-profit world. In the for-profit world, our owner's equity includes common stock, retained earnings, and paid-in capital. So again, for-profits are owned by shareholders or stockholders. No one owns a nonprofit, so we don't have any stock to purchase or any income to pay out to shareholders. Also, comparing nonprofit and for-profit, we look at the revenue sources. So in a nonprofit, a lot of organizations will receive donations or grants or program services membership dues as their primary revenue sources. In a for-profit world, it's usually the sales of goods or services. So again, we have some differences there as to where we're getting our funding from. There's also different restrictions on tracking these different types of donations and grants in the nonprofit world that we'll talk about as well. And finally, there's some differences in our tax and regulatory requirements between nonprofit and for-profit. Nonprofit organizations file an information return. That's IRS Form 990. That's filed every year. This is not an income tax return. There is no tax that's calculated on Form 990. It reports the financial information of the organization, but it also provides a lot of information on the board of directors, your programs, what you're spending your money on, if you have certain policies and procedures in place. Whereas a for-profit, they're filing a tax return. The tax return is going to calculate the taxable income or loss and how much taxes are going to be owed on that. So bottom line differences between nonprofit and for-profit financial statements. Nonprofit financial statements are emphasizing transparency, accountability, and stewardship of resources, while for-profit, really the focus is on net income and increasing that bottom line so it can be paid out to shareholders. I do want to make one comment here. The term nonprofit, not-for-profit, really is just not a good term. I've asked many times whether a nonprofit can make a profit. Yes, the answer is yes, of course. Nonprofit organizations have to bring in more money than they spend. The difference is that money goes back into the organization to continue to develop programs and pay for things in the future. It is not paid out to for-profit shareholders or owners. But of course, if a nonprofit does not make a profit, they will not be able to succeed and they will not be able to exist. So yes, nonprofits do have to make a profit. Okay, so kind of past the basics now. So let's look at an actual statement. So we're going to start with the statement of financial position. So this is a snapshot of an organization's financial health at a specific point in time. So as you can see here, so this statement here is an audited statement. However, the statements that we look at are going to have the exact same components as your internal financial statements. If you're printing them out of QuickBooks or MIP or Intact, it's going to have the same items on it. It's just going to look a little different. So these statements here are as of December 31st, 2024. So we have also a column 2023, the prior year. But so this statement is only looking at one day. So as of December 31st, 2024, this is what the organization has. December 30th is going to look different. January 1st, 2025 is going to look different. So we are looking only at one point in time, December 31st, 2024. This statement shows total assets, total liabilities, and total net assets. The first thing that you want to look at when you look at this statement is whether your total assets and total liabilities and net assets agree. If these two amounts do not agree, you might as well stop looking at your financial statements. They are wrong. These two balances must agree at all times. If they are off a dollar, a penny, something is wrong with your financial statements. So we need to make sure that these two amounts agree. So let's take a look at the assets. So this is the first part of the statement of financial position. So the top part here, again, we have 2024 compared to 2023, and we're looking at assets. So assets are what the organization owns. So this is going to be your cash, your investments, your beneficial interest here of 113,333. That's going to be your investment in the community foundation. If you had CDs, it would be in this section. Your fixed assets. So those are going to be your vehicles, your equipment, your buildings, your land. Oh, before I get much further, I should say that these financial statements that we're looking at are on the accrual basis. So if your financial statements are on the cash basis or the modified cash basis, you might not have all of these balances because they don't get recorded under those other bases. But we're looking at the full accrual basis. These are not the only assets that could be listed under the accrual basis. These are just some of the more common ones that I wanted to touch on today. All right, so we have cash and cash equivalents. So again, that's pretty checking, savings, money market, that type of thing. Contributions receivable. Okay, these are items that someone has promised to give you in the future. So again, that foundation that said they were going to give you a $300,000 grant in the future. So when they tell you that you are going to get that grant, it gets recorded as a contribution receivable and as income. So that's what that line is. If you provide program services, if you provide some kind of service and people are paying you to provide that service, you might have an accounts receivable line. If you get money from a government entity and you have to submit claims to be reimbursed, you might have a line that says claims receivable or grants receivable. So any kind of receivable, those are the amounts that someone owes you in the future. So the amount that you are going to collect. And it's really important to know that, so that way you know how much money is going to be coming in the future. Next, we have prepaid expenses. These items are expenses that your organization has paid for in advance. So the most common one is prepaid insurance. A lot of times your insurance coverage does not follow the same fiscal year that you are on. So for example, this organization reports their financial statements from January 1 to December 31st. It's more than likely that their insurance coverage does not follow January 1 to December 31st. So let's say their insurance coverage is from July 1st to June 30th. Well, at the end of the year, they've already paid all of that insurance, the premium for that insurance coverage. So as of December 31st, they would have prepaid 6 months. So that would be July 1st or January 1st to July 31st to June 30th, that 6 months in 2025. So they paid that in advance. So that gets included as a prepaid, as an asset on their financial statements. Then as those months, as they use those months, as those months go by, January, February, March, this balance is going to decrease and it's going to be moved to the expense because we're using up that prepaid. You also might have a prepaid if you pay in advance for a fundraising event. Maybe you have to put down a down payment on a venue that you're going to use in the following year. So then that down payment that you paid for in advance would be included in the prepaid balance. Investments, so again, that would be investments that you would have, whether it be, in mutual funds or stocks or any type of investments you have. Fixed assets, again, you should have a capitalization policy in place that says what types of items you are going to capitalize versus expense. So these would be, a lot of times we see $500 or $1,000 with nonprofits. However, if you have a building, you have a lot of buildings and you have a lot of repairs, you might increase that to $2,500. So that says that any items that we purchase, any fixed assets that we purchase that are $1,000 or more and have a useful life of 1 year or more are going to be capitalized on our balance sheet and depreciated over their useful life. So if we buy a piece of equipment that's worth $5,000 and that $5,000 is going to go in this section here under assets, not on your expense. And then we're going to expense that over the 5-year life through depreciation. And so we're going to expense $1,000 per year. So that $5,000 asset that's on your books is going to get reduced by $1,000 each year to reflect the usage of that asset. Investments held to restricted long-term purposes. So if you have either investments or cash that has been set aside for a specific purpose, for example, like a capital campaign or endowment, those need to be separated out from that top line cash or investments because we want to show that this is not available for operating use. It is set aside for an endowment to purchase fixed assets, something long-term rather than our operations. And again, this organization has an endowment fund, so we have that separate as well. So that's kind of a brief overview of assets. If we move on to the next section, these are our liabilities. So these are items that we owe other people. We have a couple here. There could be other ones listed, but accrued wages and withholdings. So these are payroll related items that have not been paid yet. So accrued wages would be those wages where employees have worked, so they have provided service to the organization through December 31st, 2024, but they haven't been paid yet because the payroll doesn't fall on December 31st. Maybe it ends on January 4th. And so they will get paid January 4th for this. But since they worked through December 31st, this is a liability. This is what the organization owes to those employees, so it gets recorded as a liability. Withholdings would be those items related, again, payroll taxes and health insurance and those kind of things that are withheld by the organization out of the employees' paychecks, and that will be paid after December 31st. Accounts payable are those items that the organization has either purchased or services that they have received as of December 31st, but have not paid the bill yet for. So again, it should be recorded as a 2024 liability and expense, and then those will get paid after December 31st. Also in this section under liabilities, if you had a line of credit, that would be included. If you had any kind of mortgages or notes payable, that would be included here. If your organization has any type of deferred income, so deferred income is income that you have received in advance for a service that you will provide. This is not deferred income, and restricted net assets or restricted grants are different. They are not the same. When I'm talking about deferred income, I'm talking about your organization provides some kind of service, and in exchange for that service, they get paid. Deferred income represents the amount that they have been paid as of December 31st, but have not provided the service yet. So that would be included in this section as well. Next, we have the final section, which is our net assets. Again, in the for-profit world, this is like our owner's equity section, shareholders' equity. Our net assets is basically the difference between our assets and liabilities. It's kind of like the net income of your organization since it has been in existence. And again, it is divided between without donor restrictions and with donor restrictions. So without donor restrictions, we like without donor restrictions. We want this number to be higher. That is the amount that you can use for operations. With donor restrictions are the balances of contributions or grants that have been given to the nonprofit organization for a specific purpose or a specific time period that have not been spent as of the end of the year. So this would be carried over, this 1.9 million would be carried over into 2025 to be spent for a specific purpose or a specific time period. All right. So those are the different sections. So when you're looking at a statement of financial position, what should we be looking for? What kind of questions should we be asking? First of all, again, we want to make sure total assets equals total liabilities and net assets. But as we look at the statement, we want to see if there's any kind of significant variances year over year. Hopefully, when you're looking at your financial statements, whether it be the end of the year audited financial statements or your internal financial statements, you're looking at the current year-to-date period compared to the prior year-to-date period or compared to budget. We want something to compare it to. It's much easier to understand the balances if we're looking at prior year-to-date, prior year month over month, or budget. So we can kind of see where we're at. When we're looking at those variances, we have to ask why. Is this variance expected? So for example, let's go back to contributions receivable. So if our contributions go up greatly, huge amount, maybe that's because we got that multi-year $300,000 grant from a foundation this year. So every 3 years we get this grant. So that means every 3 years our contributions receivable is going to go way up. So that's expected. We're expecting our contributions to go up because we got that large grant. Now, if we didn't get that large grant and our contributions went up, we should ask why. Is that because we're not collecting these receivables? Maybe someone said that they were going to give you this grant or this contribution and they haven't paid it yet. So that would be a concern. Same way with any kind of accounts receivable. If the balance is going up, is there any kind of concern that we're not receiving payment on those receivables? When we look at investments year over year, does it follow what the market is doing? You know, if the market has gone down, our investment balance should probably go down as well. If the market went up, our investment should go up. Cash. So we want cash to be positive, obviously. Sometimes I've seen it where cash is not positive. We want to have a positive cash available for operations. Best practices say to have enough cash to cover 3 to 5 months of expenses. I've been asked before if there is a limit as to how much cash or investments a nonprofit can hold. The answer is no. There is no limit that says a nonprofit can only have so much cash or so much investment. However, you have to remember that your organization is not a bank. It's not an investment firm. Your organizations exist to provide some kind of programming, some kind of activity. And so you want to make sure that your organization is doing that and not just hoarding a bunch of cash or investments. Now, there might be some instances where you have an excessive amount of cash or investments on hand. For example, if you're planning to do a capital campaign in the future, or you're planning to start a new program in the future, maybe your organization is, kind of needing to collect some extra cash or an extra investments because they're going to invest into that capital campaign or into that new programming. So for this year, we have more cash on hand than usual, and that's perfectly fine. You can certainly explain that. When we look at the liability set, well, one other thing on on the asset section, when we look at our fixed assets, we need to have an understanding of how old those fixed assets are, because those fixed assets are used to provide our programming and what we do. Those fixed assets are not going to last forever. Eventually, they're going to be needing to be replaced. So when they get replaced, how are we going to pay for that? Are we going to take out a loan? Do we have cash to pay for that? Are we going to have to ask a funder for a grant to pay for that? So you want to make sure that you understand how old your fixed assets are and the timing of when you're going to need to replace those. Because again, without those, you're not going to be able to provide your service. Moving down to the liability section, when we're looking at accounts payable specifically, is that amount growing? If it is growing, maybe it's just a fluke and we just got a large invoice in at the end of the year that we haven't had a chance to pay. It could be a timing. But it also could be that we're not paying our accounts payable timely. We're not paying those invoices as they come in. So if you have a large increase in accounts payable, you want to make sure that your accounts payable are being paid. Same way with the payroll withholdings and accruals, we want to make sure that we are paying all of our payroll taxes. The IRS does not like it when they don't get their payroll taxes. And for an organization that does not pay their payroll taxes, the IRS could come back on the actual board members personally. So you want to make sure that your payroll taxes are being paid timely. Also, under the liability section, if you have a new mortgage or a new loan, is that correct? Obviously, as a management or a board, you should be aware if the organization took out a loan this year. So you would want to see that, okay, yes, we did take out that loan, or wait a second, where is that loan that we took out on there? And then also just making sure that payments are being made against that. And then finally, under the net assets section, we want the without donor restrictions to be positive. I have seen it where that is negative. If the without donor restrictions line is negative, that is bad. That means that your organization has borrowed against the with donor restrictions. That is not good. That means that someone has given you money for a specific purpose and you use that money for your operations instead of that specific purpose. Again, that is not good. So we want to make sure that without donor restrictions is positive. We really like it to be much bigger than the with donor restrictions because that way, again, that's what you can use for your operations and you're not restricted to a specific purpose. Questions on the statement of financial position at this time? I know this is kind of a high level overview, and if you look at your own organization's financial statements, they might have some different assets or liabilities listed. But again, just kind of trying to give you an understanding of what is on these statements and what kind of questions to ask when you're looking at them. So the next slide here kind of goes over again some of those questions to ask when you're looking at your statement of financial position. And again, these slides will all be emailed out to everyone after the session is over. So why is the statement of financial position important? Well, I mean, it's a required financial statement of a nonprofit, so you have to have it, but it also helps leadership and those looking at it assess the financial stability. Again, how much cash do we have? How much assets do we have? What are our debts? What are our debts to others? It's required for financial reporting and audits and on the 990. And it's also used by donors and funders to evaluate financial health. So again, important statement for nonprofits. Okay, next is the statement of activities. So this is basically your income statement in the for-profit world. So this shows a nonprofit's revenues, expenses, and the changes in net assets over a specific period, such as a month, quarter, or year. Okay, so when we look at this, we are looking at this statement for the year ended December 31st, 2024. So unlike the statement of financial position that we just looked at, that was for one date, December 31st, only one date. This statement is for a period. It is for the whole year. So this includes all the revenues and expenses from January 1 to December 31st, 2024. And it's broken down into two columns, without donor restrictions and with donor restrictions. And then we have last year's in 2023. So again, we have the total support revenue and expenses, total support revenues and gains, the total expenses and losses, and then our change in net assets. Our change in net assets is really our net income or net loss in the for-profit world. So unlike for-profit organizations, again, which focus on net income or profit, the statement of activity really focuses on tracking the organization's net assets and the changes in them, emphasizing both unrestricted and restricted sources of revenue. So where are we getting our money from and what are we using it for? How is it being used for our programs and missions? So we're going to just take a piece of this and we're going to look at the top part. So this is just money coming in. So this is your support, revenues, and gains. So again, we have three columns for 2024, without donor restrictions, with donor restrictions, and then the total for 2024. So when we look at this, the without donor restrictions and with donor restrictions column, think of it really as your pockets. So your left pocket's going to be without donor restrictions, and your right pocket is going to be with donor restrictions. So when money comes in and it's restricted for a specific purpose, it goes into the right pocket. It goes into the with donor restrictions column. Then when we spend that money on program X or whatever purpose we're supposed to spend it on, we're going to move it from the right pocket into the left pocket, into the with donor restrictions to without donor restrictions. That is what the line called net assets released from restrictions does. All it is doing is moving money from the right pocket into the left pocket, because we can't take any money and spend it to outside vendors from the right pocket. It has to go through the left pocket first. So money coming in with restrictions. And again, only donors can restrict purposes. If the board says that they want to designate a certain amount of money for a specific purpose, that's fine, but that's called designated fund. This right here, we're only referring to restricted funds, and restricted funds can only be restricted by outside donors. So only donors can restrict this. Now, if a board member makes a personal donation and they want it restricted for a specific purpose, that's fine, they can do that. But in general, restrictions can only be made by donors. Designations can be made by board. Okay, so again, money coming in. So in this specific example here, during 2024, this organization had $696,000 of contributions that came in for the year that was restricted for a specific purpose. They have to use it for either time or purpose. They also had $1.8 million come in that was not restricted for any kind of purpose. They could use it for whatever they want. Again, we really like it when we can use it for whatever we want, because that way we can use it for our daily operations. The next line, contributed non-financial assets, this is your in-kind. So this is your in-kind facilities, goods, or services. Now, for GAAP purposes, for accrual purposes, not all types of donated items get recorded on your books. So for example, services. If the service requires some kind of specialized skill, so like that person had to go to school to get this skill, that would be required. For example, if you had a lawyer, an attorney that donated their services, that requires a specialized skill. So that would be reported. If you had individuals come in and stuff envelopes for you, that does not require any kind of specialized skill. So that would not be recorded in your financial statements. However, you should record these types of items outside of your financial statements, so that way you can track what kind of support you're getting from the community. Same way with we talked about services. So like goods, if you have donated items that are either being used by the organization or sold by the organization, those are recorded on your financial statements. If the organization just passes them through, those are not recorded on your financial statements. But again, you should track all of them outside of the financial accounting software. And then also facilities. If the organization receives any kind of donated facilities for its use in programming or administrative, we need to record those as in-kind. Also, we record the items as in-kind if the organization would have had to otherwise pay for them. So for example, let's say this organization received $25,000 value of advertising because this marketing class at the local college decided to have a project where they pick a local nonprofit and they revamp all their marketing for them. And so this nonprofit was selected to do that. And as a result, this nonprofit received about $25,000 of advertising services. Obviously, that's a professional service because it's unique. Somebody off the street can't do that. So it meets that criteria. However, the nonprofit would not have gone out and paid $25,000 for advertising services if they had not received this gift through the college. So in that case, they would not record it because they wouldn't have otherwise paid for it. So it really depends on the circumstances as to whether you record those donated items. However, you should always track them no matter what. So that way you can have a record as to who is supporting your organization and how. Next line is government grants. So some organizations receive grants from either local, county, state, or federal government. So those usually get reported separately because there are separate reportings that need to be done for those. So that's what that is. The next two lines, special events. So these are your fundraisers. This is your gala, your dinner, your auction. We have it broken between proceeds and direct benefit for donors. So the proceeds line, this is going to be like the exchange portion. So when you go to a fundraising event and you purchase a ticket and it's $100 and $80 is a contribution and $20 covers my meal, it's an exchange portion. The $20 goes on this line under proceeds and the $80 goes at the top line under contribution. So we split that out. Direct benefit to donors, that is what the individual that's attending the event is basically getting in return. So that's going to be the meal, that is going to be the facility cost, that's going to be those direct expenses. It's not going to be the postage for the invite or the printing, that kind of thing. Program service fees, this is revenue that's generated from some type of service that your organization is providing. Whether you provide some kind of like educational training or maybe some therapy or counseling, your organization is providing something and in return they are getting paid. So that's what that is, an exchange service exchange transaction has occurred. So we record it separately as program service fees. This organization just also has some other income, which is just kind of general, doesn't really fit into another category. It's not a grant, it's not a contribution, it's just kind of miscellaneous. Investment income is going to be your interest income on your investments net of fees. And then we have gains, unrealized and realized gain on investments. So again, various types of revenue coming in. Some organizations might just have 100% contributions, which is fine. Other organizations might have other membership fees, they may have rent income, might have other types of revenue in this section. But this is, again, where you can see where your money is coming from in order to provide your programming. So the next section is your expenses. As you can see here, it's broken down into only three sections for 2024. So nonprofits are required to allocate their expenses to show their expenses by function. So function is program, management, general or administration, and fundraising. So that's what this section does. It shows those different functions. We do not have any expenses in the with donor restrictions column because we cannot. Again, we can't spend money from the right pocket. It has to come out of the left pocket. So it goes from the right pocket to the left pocket. It goes from with donor restrictions to without donor restrictions, and then it gets paid out. So that's what this section. Again, your expenses, these are the costs that the nonprofit is incurring to fulfill its mission and its operations. When we talk about program expenses, these are expenses that are directly related to your mission, your activities, your programming, the time that people are spending, the supplies that's needed, the facility costs that's needed to provide the programming. Administration or management in general, these are just kind of general operating expenses that you have to incur because you're operating a business. This is going to be your payroll fees. This is to process payroll. This is going to be your audit fees, probably your bank fees. These are just general business expenses that have to be incurred because you're running an organization. And then fundraising expenses are those expenses that are incurred to get people to give to your organization. So it could be those indirect expenses for your fundraising event. So maybe the postage, the mail for the mailing, the printing. It could be your grant development person. It could be other mailings that you are sending out. So it's those expenses that are incurred to get people to give to your organization. And then the final section here is your change in net assets. So your change in net assets, again, is the difference between total revenues and expenses. In the for-profit world, it's your net income or your net loss. So in 2024, we have a positive 426,331. So that means we brought in more money in total than we spent. In 2023, that number was negative. Sometimes that happens. We hope that every year is not negative though. So we had a swing and in 2024, it went positive. Then we have our net assets at the beginning of the year and our net assets at the end of the year. And again, we have it broken down between the two pockets without donor restrictions and with donor restrictions. So at the end of 2024, we have $1.9 million of money that has come in that is restricted for a specific purpose that has not been spent yet. Now, this organization has an endowment. So that endowment makes up a good chunk of that $1.9 million. They are probably never going to spend, or they shouldn't spend some of that endowment because it's permanently restricted and means they can't touch that permanent portion of it. So that's why this is so large. So that would be included in there. But they also have other items that have been received for specific programming, maybe 2025, that has not been spent yet. So some of that will be spent next year in 2025. So when we're looking at the statement of activities as a whole, again, this is our full statement here with the first 3 columns of 2024, and then the final column is 2023. So what kind of questions do we look at? Well, when we're looking at revenue, we want to know where our revenue is coming from. So the concern here is concentrations. Do we have a concentration where we're getting a significant amount of revenue from a specific donor or a specific source? If we do, that might be a problem. So for example, if we get a large amount of money from a certain foundation in town and that foundation decided to not fund us anymore, what would we do? Would we be able to survive? Would we be able to get revenue from other donors to cover that? Or maybe your organization receives a significant amount of money from the government. Maybe it's only 1 or 2 programs from the government. If that were to go away, would you be able to survive? Could you be able to get money from other sources to cover that? So when you're looking at your financial statements, you want to make sure you understand where your revenue is coming from. Now, some organizations, they're 100% supported by contributions, which is fine. However, you just want to make sure that you're getting contributions from different sources, from different individuals, corporations, foundations, grantors, that we're not relying heavily on one source. That's where the concentration comes into play. You also want to look to see if there's any new revenue sources. So nonprofit organizations are exempt from paying income taxes. That's one of the benefits that they get. However, they do have to pay unrelated business income tax. Now, this is a very gray area. I'm not going to go into it too much in this webinar. However, I do want you to be aware of unrelated business income taxes. An organization has to pay these taxes on unrelated business income. Unrelated business income is income that is received from a trade or business, is an activity that is considered a trade or business, regularly carried on, and is not related to your organization's purpose. It does not matter that the money is going back into the organization to pay for your mission. The IRS does not care what you're doing with it. They are focused on what activity generated it. So if you have some type of activity, some type of new revenue source that you haven't had in the past, you want to make sure, hey, is this unrelated to our activity? Do we need to pay taxes on it? It's okay. If you have unrelated business income, you take your unrelated business income, you deduct it by the related expenses, you come up with a net amount, and you pay income tax, or not income tax, but unrelated business tax at the same corporate level as for-profit businesses. It's okay. A lot of nonprofits have unrelated business income because it's an additional source of revenue. However, the issue comes up when that becomes a significant piece of your organization. The IRS does not like it when there is a significant amount of unrelated business income within a nonprofit. Significant is not defined. I've seen it where it's 20% of revenue. I've seen it where it's 80% of revenue. Also, what is considered unrelated business income for one organization is not considered unrelated business income for all organizations. It is a very gray area. So bottom line is that when you look at your statement of activities, if you have a new revenue source, you just want to make sure that you understand what is driving that revenue source. You also want to look to see comparable year over year. Did it go up? Did it go down? Why? Did we have a large capital campaign this year? It went up. Did we lose a large funder and it went down? Same way with expenses. We want to make sure we understand the variances between those. Also, when we're looking at this, we want to look at restricted versus unrestricted. So without donor restricted versus with donor restrictions. Again, if we have a significant large amount of with donor restrictions, then is that a problem? Will we be able to spend that? Do we have enough for our operation? So that's one thing to consider as well. Do we have a deficit in our change in net assets? So again, 2023 was negative. So if 2024 would have been negative too, we might have had to look into that a little bit more. Okay, what's going on here? Are we going down the wrong, are we slipping down the slide the wrong way? But 2024 went up and it increased to 426, which is good. So maybe 2023 was just a fluke year and we had something going on that year that didn't usually occur. So again, that's something to think about there. We had a question about if there's any articles you can point us to about unrelated business income. Yes. In the email that goes out after this, I will include a link to some blogs that we have and also some webinars that we have that talk about unrelated business income to give you some more information on that. All right, so again, questions to ask, we kind of covered those. Why it's important. So the statement of functional expenses, again, is a required statement. I'm sorry, statement of activities is a required statement. A couple things why it's super important. Revenue tracking. It helps nonprofits track fundraising and revenue generating activities. So you can see how much fundraising expense is going in and how much money you're getting in return, the contributions and grants. Also, expense management. It provides insight into how efficiently the nonprofit is spending its funds in pursuit of its mission. It gives an overview of the financial health of the organization. It shows whether the organization is generating enough revenue to cover its expenses, whether your net assets are increasing and decreasing. And then also donor confidence. It helps donors and funders understand how resources are used and how much is available for mission-driven activities versus administrative or fundraising costs. Okay, the next statement is a statement of functional expenses. And so on that previous statement of activities, we only showed 3 lines for our expenses: program, administrative, and fundraising. So this statement of functional expenses kind of goes with that. It provides a detailed breakdown of your organization's expenses. So not only are they organized by functional classification, but also by natural classification. So this really shows where that money that's coming in, how it's being used. So again, this is for a period of time. So this is for January 1 through December 31st, 2024. And we have the total column there on the right. And then we have our 3 functions: program, administration, and fundraising. So when we look at this statement, this only shows the program service column. So I wanted to point out the items on the left there are your natural categories. These are the actual types of expense, whether it be salaries or supplies or technology. So these are the breakdown of what type of expense that you have. These obviously are not a list of all-inclusive expenses. This is just some common ones. What you use, what you show in your financial statements may vary from someone else. It just depends on what you want to see, what the reader of the financial statement wants to see in this area. And then across the top, again, we have our program, administration, and fundraising. We're required to disclose this on the financial statements and also on Form 990. So again, we talked a little bit about what makes up each of the program, administration, and fundraising, what kind of expenses go into there. However, we didn't talk much about allocation. So when we look at expenses, we have both direct expenses and indirect expenses. Direct expenses are those expenses that are directly, we know for sure they're a program expense, we know they're a fundraising expense. For example, you have a development director and you pay their salary. They are 100% fundraising. They're going to go in that fundraising column. Or for example, you have a education program and you purchased a whole bunch of books for this education program. That is 100% education program supplies. However, you have several expenses that probably fall into each one of those categories. For example, if you're a small organization, your executive director's salary, they probably need to be split between program, administration, and fundraising. So we need to figure out how we're going to allocate these expenses. The allocation must be reasonable and consistent. So reasonable and consistent, what does that mean? Well, reasonable means you have to have some kind of basis to determine how you're going to allocate those expenses. When we're allocating salaries and related expenses, those are often allocated based on time. How much time is each person spending in the different areas? You could also use full-time equivalents or square footage for those expenses that are related to your building, like your maintenance or your repairs. It just had to have some kind of basis that you're using to allocate these expenses, like this percentage here, this percentage there, and it needs to be consistent. Allocation of expenses based on revenue, like how much revenue the program brings in, or administration or fundraising, doesn't work. That is not a reasonable basis. Allocating expenses by what you said was going to be used in the budget doesn't work. Not a reasonable basis. Cannot use that. So you have to have some kind of reasonable basis method in place to allocate these expenses. Also, when you're talking about allocation of expenses for your financial statements in GAAP or the 990 is different than allocating expenses for grants or for like government grants specifically, because there are certain grants that will pay for like administrative type services. That's fine. You can use that for the grant, but that is not the same as how it should be allocated for this purpose that we're talking about today. So just know there is a difference here. When we're looking at the statement of functional expenses, a couple things to ask is, first of all, we want to do comparable year over year. Where are we seeing variances? Did salaries go up a lot? Did we hire a bunch of new people? Maybe salaries went down because we lost a long-time employee. Different expenses, why are they going up and down? We also want to look to see, okay, are the expenses, the different categories that we have on the left reasonable? Are those the ones that we want to portray to the reader of the financial statement, or should they be changed? Should they be some of them combined? Should they be more detailed? And then also, how much are we allocating to program administration and fundraising? So best practices say 70 to 75% of your total expenses should be allocated to program expenses, or program services. And then the remaining 25 to 30% to administration and fundraising. However, that is just kind of a best practices. That does not mean that all nonprofits have to allocate using that percentage. It's going to vary based on your organization. If you have a large capital campaign going on, you're going to have a higher percentage going to fundraising. If you're a younger organization that's just starting out, you're going to have more expenses going to program. So you really need to compare year over year how much percentage of each of these expenses is being allocated to each one of these functions, and then compare that. So again, some questions to ask. We've kind of talked about those. Why this statement is important. It provides transparency to donors, funders, and stakeholders so they can clearly see how the funds are being spent. Accountability, and that it helps demonstrate the nonprofit is using its resources efficiently and effectively to achieve its mission. Compliance, the statement is required by accounting standards, and allocation of expenses is required not only by the financial reporting, but also Form 990, helps ensure consistency and transparency in financial reporting. The next statement is a statement of cash flows. I'm not really going to go into this because we are running out of time, and this stuff information will be included in the slides, but it just kind of talks about the cash and where the cash is coming from and how it's being used. So you can have that information there. Questions to ask. I will say that it is important for cash management because it helps assess whether the nonprofit has enough cash to meet its current and future obligations. You will probably not have a statement of cash flows in your internal financials. This is probably only provided to at the end of the year. It provides liquidity and solvency. The statement shows the nonprofit's ability to generate cash from its operations, and then it's also divided into investment and financing and transparency. We had a question, which of these forms needs to go to potential funders when they request your financial statements? That would be all of them. So a complete set of financial statement includes your statement of financial position, your statement of activities, your statement of functional expenses, and your statement of cash flows. So if they are asking you for an audited or reviewed statement that is prepared outside by an independent accountant, that's what you're going to provide, all of them. If they're asking you for your internal financial statements, it's going to be your statement of financial position and your statement of activities, because you're probably not, I am guessing that you're not creating the other statements, but they do want to see all of those statements together because it provides a whole picture of your organization. Because like I said, the nonprofit financial statements, you need to show your balance sheet, your statement of financial position, your income statement, your statement of activities, your statement of functional expenses, all of those together are showing your reader of your financial statement where you're getting your money from and what you're spending it. It's really telling your organization's story. They reflect the mission, the activities, and the financial health in a way that goes beyond just the numbers. So yes, there are numbers on these statements, but if you look at it and ask correctly, you can see the story and what is being used in the financial. Unlike for-profit businesses, which focus on profitability, nonprofits use their financial statements to demonstrate how they're using their resources to fulfill their mission. So that's why it's so important. We do have a question. Where does interest from restricted donations investments go? Can it be spent as unrestricted? So when you get, I'm assuming this has to do with like endowments. So if you get a donation from someone and they say that you have to use this money like as an endowment, like here's $100,000. You're going to put this into an investment account and you're not going to touch it. But the earnings off of it, it depends on how the contract reads or how the donor wants it spent. Sometimes it can be used for whatever you want. So it would be for that without donor restriction column, and you could use it for operations. Sometimes the donor will restrict it for a specific purpose, and they say, okay, you can't touch this $100,000, but any of the earnings coming off of it can be used for program X. So it really depends on what the donor wants and their intent, because in the nonprofit world, it's very important to make sure that you follow the donor's intent for those donations. Hopefully that answers your question. I did want to just have this one last slide to provide some additional resources that are on our website. We provide a bi-monthly webinars. So various topics, you can go out there and sign up for those. Their recordings are also available on our website. We also have bi-weekly blogs that we write that talk about different issues that we feel are important to nonprofits in our community and ones that we serve. These blogs are written by us, so we don't just say, okay, hey, there's this new national thing that's coming out, and it really doesn't apply to the nonprofits around here. We're not going to put that in there. We're going to put in what we think nonprofits around here need to know and need to understand, and we try to communicate that in using layman's terms and not a bunch of jargon. So hopefully those are beneficial to you. So again, just wanted to provide that as a resource for you. Thank you all for attending today. Thank you for all that you do for your nonprofit and our community. And hopefully we will see you next month. Thanks.